Hey everybody, I'm back to talk to you about the money market. We talked about demand last time. Now we're going to talk about money supply and monetary policy. So monetary policy's main goal is to influence the economy, either speeding it up or slowing it down by changing interest rates. So today we're going to talk about exactly how the Federal Reserve Bank, and the system goes about doing that. So I gave this to you in notes last week. It's easy to forget this stuff, so try to remember it as best you can. There are four tools for using for monetary policy. The basic four tools are open market operations, which is the government buying or selling bonds or securities. Securities bonds used interchangeably on my test and on the AP test. Changing the reserve requirement, which we've talked a lot about because that's the money multiplier. Okay, so change the reserve requirement, how much banks have to hold in the vault versus how much they can lend out in excess reserves. The third tool, which I never talked to you guys about, but I had Mr. Clifford do, is the discount rate. The discount rate is the interest rate that the Fed charges commercial banks for loans. So if you're, say, BMO Harris Bank in New Lenox and you need money to finance a subdivision that you're building in Manhattan, you might get a loan from the Federal Reserve Bank of Chicago, and the interest rate you would pay is the discount rate. The fourth, and one that's being used frequently over the last really 3 decades by the Federal Reserve, is the federal funds rate. Okay, so if the discount rate is the interest rate charged by the Fed on loans to banks, the federal funds rate is bank-to-bank loans. And this is big because I know it shows up on the Unit 4 FRQs Part 2, just defining the federal funds rate. Okay, so you think of it as bank-to-bank loans. So BMO Harris wants to borrow money, it can borrow money from Chase or the First Bank of Manhattan or Lincoln Way Bank. Okay, and the interest rate it gets charged is the federal funds rate. So let's talk at least a little bit about how each of these affect the money market. There's our happy little money market graph. So when the economy, kind of like right now, we're trying not to panic, but we're in a slowdown time in the economy right now. And so the Fed is trying to speed it up a little bit, trying to boost the economy, trying to keep it out of a recession. For that, it would use expansionary monetary policy. And so expansionary monetary policy, the ultimate goal is to boost the money supply. As I'll show you here. So we increase the money supply. It's easier with a whiteboard behind me. All right, so we've increased the money supply. Increase the money supply does what to interest rates? That's right. Increasing the money supply decreases interest rates. So we have four main ways we can do that, and I'll write them on here. You can, I'll do the initials, buy bonds. So buy bonds. The Fed buys bonds, that decreases the interest rate because it increases the money supply. So the Fed buys bonds, think of it this way. If I'm buying bonds, I'm the Fed and I buy bonds from a commercial bank, I'm giving that bank money. The bank now has more in reserves. The bank can then loan out that money at a lower interest rate to potential customers, businesses, homeowners, things like that. So buying bonds increases the money supply, lowers interest rate. The second option, decrease the reserve requirement. So decrease the reserve requirement, banks can have more excess reserves. They don't have to keep as much in the vault. They can loan out more. This increases the money supply. Lower the discount rate. Okay, lowering the discount rate means that if you're a commercial bank, you don't have to pay as much for your loan. This means you'll borrow more. If you borrow more, you often pass that savings on to customers and businesses. Lower the discount rate, increases the money supply. And then finally, lowering the federal funds rate. If you lower the federal funds rate, banks are more likely to borrow, in this case from each other, and they'll pass the savings on to you. So all of those together, those are all examples of expansionary monetary policy. All of them increase the money supply, and in increasing the money supply, that lowers interest rates. And we'll talk a little later, maybe tomorrow. Remember, lowering interest rates boosts investment. If it boosts investment, it boosts aggregate demand. This is one of the main themes we've been trying to get at this week with the Unit 4 FRQs Part 2, okay, this kind of chain reaction here. Now, we might use contractionary monetary policy. It's not as frequent. It definitely hasn't been all that popular with the public, just like raising taxes isn't popular with the public because it slows down the economy. The only time you'd want to do that is when there's inflation. So you think expansionary when we're boosting the money supply, contractionary when we're fighting inflation. So in this case, we want to decrease the money supply. And here's my correctly labeled graph. So I want to shift money supply to the left in this case. So I'm shifting from SM to S3. That's contractionary monetary policy. The four options for that would be, well, instead of buy bonds, if the Fed sells bonds, and this is one of those things in number 4 on FRQs Part 2, sell bonds, okay, that means basically the Fed sells bonds to commercial banks. If they're selling bonds to commercial banks, they're giving the banks bonds and taking the money out of circulation. The banks' reserves go down. They have less money to loan out. Money supply decreases. Raise the reserve requirement. RR goes up. It means banks have to keep more in the vault. They don't have as many excess reserves. Less excess reserves, less loans. Money supply goes down. And finally, the last two, discount rate up and federal funds rate go up. In both cases, if the discount rate goes up, okay, banks will not borrow as much from the Fed. If the federal funds rate goes up, banks will borrow less from each other. And at the end of the day, if they're borrowing less, you're going to be borrowing less because they'll pass the extra cost on to you guys. You know, one of the things that has kept interest rates low for things like homes and cars over the last really 20 years has been a low federal funds rate. It's basically like 0% right now because, again, the whole idea is right now we're using expansionary monetary policy to try to boost the economy, put these low interest loans in there, and businesses will borrow more, businesses will spend more, money supply goes up, interest rates go down, aggregate demand goes up, bada bing, bada boom, the economy is great. Knock on wood. Okay, so let me know if you have any questions. We'll talk. I'll come back again probably tomorrow, do a little video on the chain reaction because that's going to play a big role on the test and on the AP test. Okay, is knowing, all right, money supply goes up, interest rates go down, aggregate demand goes up. What happened to GDP? What happened to unemployment? What happened to price level? So that chain reaction through the economy is really key to understanding. Email me with any questions, and I'll see you later.